In the past 2 weeks, a banking crisis has swept through Europe and the United States, from Silicon Valley Bank to Credit Suisse to Deutsche Bank, following the collapse of a number of large banks in the United States. In addition to the nearly 200 banks facing the risk of a crash, this banking crisis has spread to Europe. First, the crisis broke out in Credit Suisse, and the Swiss government had to quickly allow Credit Suisse to be sold cheaply, even at the expense of changing the law and the interests of creditors. And this attitude made people feel that the problem was not quite simple at all. Within a few days, the share price of Deutsche Bank, Germany's largest bank, began to plummet again. Despite the outbreak of the banking crisis, the Federal Reserve still raised interest rates by 25 basis points, causing US stocks and crypto markets plummeted. Hello everyone, this is Big Hertz. In this video, we will talk about why the Fed chose to raise interest rates by 25 basis points despite pressure from all sides. How will this crisis end? When will the US stop raising interest rates? Kindly remind that this video is for reference only and does not constitute any investment advice. If you like my videos, remember to subscribe and turn on the little bell so you don't miss the updates. After the banking crisis erupted, the market once bet that the Fed would suspend interest rate hikes, pushing the Fed to a dead end. The Fed is now in a situation like flying a plane through thunderstorm clouds. As it continues to raise interest rates and the external environment deteriorates, continuing to pull the plane up is likely to disintegrate in the air. But abandoning the effort would be equally disastrous. The root of this banking crisis is the rapid increase in interest rates by the Federal Reserve and the European Central Bank in response to high inflation after major deflation. Today, on one side, many small and medium-sized banks are in liquidity trouble, while on the other, inflation remains uncontrollable. In the 1970s, the Federal Reserve started cutting interest rates when the CPI fell slightly in order to stabilize employment, and this was repeated several times, eventually leading to stagflation. With this precedent in mind, the Fed will not turn easily. Although inflation slowed at the end of 2022, recent data shows signs of inflation is starting again. US core CPI rose 0.5% in February from a year earlier, above expectations of 0.4%, and has been increasing since November 2022. Faced with the dilemma of inflation and the banking crisis, the US government launched a bailout plan and at the same time raised interest rates by 25 basis points. Does this indicate that the Fed is confident in the banking sector and will continue to raise interest rates? In fact, although the Fed still chose to raise interest rates, Powell made it clear that the Fed had at one point considered suspending interest rate hikes and also that the banking crisis would have a negative impact on the economy, leading to similar effects to the rate hikes. So in the end, the Fed only raised rates by 25 basis points, below the previously expected level of 50 basis points, and the Fed removed the phrase "continued rate hikes are appropriate" from the last 8 statements, replacing it with "some additional policy firming may be appropriate." This indicates a change in the Fed's attitude towards future rate hikes, suggesting that the current cycle is nearing its end. Evidence in support of the approaching end of rate hikes also includes a dot plot reflecting officials' views on interest rates. Interest rate expectations remains at 5 to 5.25% at the end of 2023, suggesting that there may only be room for one more 25 basis point Fed rate hike during the year, and 10 of the 18 officials supported this view, an overwhelming majority. Also, given the turmoil in the banking sector, the Fed lowered its expectations from the US economy. The US economy is expected to grow by 0.4% and 1.2% this year and next, respectively, down 0.1 and 0.4 percentage points from the December 2022 forecast. The weak growth outlook is very bad for US President Joe Biden, which has said he plans to run for re-election next year. And the 2-year US bond yield fell sharply, at one point dropping below the 30-year US bond yield, with the yield inversion fading and a recession close at hand. While interest rate hikes may be nearing end, The problem now is that there is a great deal of uncertainty about evolution of the banking crisis. The banking system relies on market confidence, and although governments have bailed out banks while reassuring the markets, this is what governments assured the public of during the financial crisis of 2008. The immediate cause of the collapse of Silicon Valley banks was not a loss, but a run. Now that a crisis has erupted in the banking sector, and the situation could worsen at any time in just a few days, depositors who trusted banks the day before could suddenly panic, and the panic could quickly spread to the whole country or even the world. By then, well-capitalized banks would be in trouble. In addition, behind this banking crisis is the Federal Reserve's interest rate hike policy. The consequences of the continued sharp increase is still slow emerging, and it is not clear how the interest rate hike will affect bank loans, except for the huge bond float. Only when the tide has gone out can we see who is swimming naked. While it is difficult to predict the exact timing of the black swan, it is clear that Silicon Valley Bank is only the first casualty, and the longer the financial crash lasts, the greater the risk to the banking and non-banking sector. The default on BlackRock's commercial real estate mortgages, for example, may just be the tip of the iceberg of systematic risk in shadow banking, which has neither the liquidity support of the Federal Reserve nor the deposit insurance of the FDIC, and will become even more uncontrollable in the event of a run. So, what does this banking crisis mean for the crypto market? The banking crisis has undermined the confidence that the banking system relies on, while Bitcoin has attracted more attention as an asset that does not rely on centralized institutions. And with the recent weakening of the US dollar, the price of Bitcoin has once again surpassed $28,000 after a 9-month hiatus. After a major purge over the past year or so, the crypto market bubble has gradually disappeared, and the rest of the year is likely to see more financial risk events around the world, further signals a recession in the US and Europe, an expected subsequent drop in actual interest rates, and of course, an opportunity for Bitcoin. That's all for today's video. Remember to like and subscribe. See you next time.